Welcome to Sit and Stay, the podcast that breaks down the challenges of starting and maintaining a mental health practice into digestible chapters. Sit and Stay is presented by RipsyTech, an electronic health record company committed to addressing the mental health crisis in the United States.
Hello, and welcome back to the Sit and Stay podcast, the show where mental health providers learn to keep their practice healthy alongside their patients. Brought to you by RipsyTech, an electronic health record company dedicated to addressing the mental health crisis in the United States. As always, I am RipsyTech product manager Parker Anderson, and I am joined by the founder and CEO of RipsyTech, the Quarktastic Tom Tarshis. Hi, Tom.
Hey, Parker. I'm not sure that's a real word.
I don't think that is a real word, no. Just full disclaimer, I am not the author of these adjectives. I just type in funny adjectives and I just pick one. So, yeah, you get to be Quarktastic today.
I like it.
So,
I like it.
Thanks, Tom. So, quick updates on the podcast. We are currently releasing episodes every 2 weeks. So, this episode's actually not going to come out for about 3 weeks after we record it. And that is because of just, some personal life changes, some unavailability on my end with baby on the way. So, that's coming up, but hopefully our listeners are coping with the staggered cadence just fine. Now, what are we talking about today in this week's episode? You had the idea to talk about private equity and venture capital investments and their role in mental health businesses. So to just get the conversation started, tell us a little bit about what this means and how do they typically influence the strategic direction of mental health practices?
Yeah, no, and it's a interesting topic because sex and money are good topics to talk about and get interest. And we recently had a great sex therapist on the podcast. So now let's talk about money. But, ultimately, this is something that before the pandemic, you maybe didn't hear too much about in mental health. That mental health wasn't really a field that got a lot of interest from the powers that be with a lot of money, but then all that started shifting, as stigma's been dropping, as telehealth technology has increased, and from the pandemic, which created a lot of mental health awareness, all of a sudden lots of interest has come into this field, and that continues today with the sort of AI link in medicine and mental health and other pieces. So kind of around 2020, maybe a little bit earlier, that lots of interest has come from people with money to get into this field. And in very broad terms, there are sort of two classes of entities that invest in businesses. And one is called private equity or maybe growth equity, or they come up with different names, but they're sort of the same. And then the other is venture capital. And let's test Parker's knowledge. What is the difference between private equity and venture capital, Parker?
So my best understanding of the difference between the two of these is that private equity would more likely be investing in a business that has kind of like established its own steady revenue stream, whereas venture capital might be some kind of fun, new, exciting idea that you're trying to get off the ground, more likely like early stage startup, whereas private equity, if you're a mental health practice that's been established, that's looking to expand, I'm imagining private equity is the more likely of the two. But if you're saying, I'm going to start this mental health practice that, I don't know, everybody's AI. All the therapists are, some crazy idea that somebody can invest in, then you'd be looking at venture capital more likely. Did I get that correct?
Parker, you are spot on, and maybe you just had a $1 billion company idea with your virtual AI therapy
Sounds like $1 billion lawsuit.
But yeah, no, that's very true. So private equity, and again, I'm not a MBA or business person, though feel fairly knowledgeable about these topics. Private equity will typically look to a company that is generating $1 million or more in revenue a year. It doesn't necessarily need to be profitable, but in general, looking for companies with high revenue, profitable or on a path to being profitable, and then like to come in and buy and take full ownership, which is like 51% of the company, so that they can make all the decisions around the future direction of the company. And conversely, venture capital, would be, someone has an idea, they haven't even started the business yet, but all they have is this great idea. A venture capital group might come in and say, hey, we like your idea. We're going to give you a seed round of funding, or, a few $100,000 to develop it, and then see where it goes. And the venture capital people will usually invest very early, where they get high value for their investment in terms of shares and ownership. They don't usually, it's not as firm of a set requirement that they need full control or ownership, though usually any investment gets seats on the board to have some influence in the direction. And, the way private equity, quote, makes money is they buy businesses, try to streamline operations, and then in 5 years or so, hope to sell it to another company after they've made the revenue higher or the profit higher. And so it sort of just churns through like these growth phases. Venture capital tries, and private equity is, hopeful that every deal they make is going to turn into a good return. By contrast, venture capital, they'll invest in lots of different companies, and they know that maybe 90% of those investments are going to fail. But if they get the 10% that these ideas make it big, that more than makes up for those 90% of investments that they lost. And so it's a different approach that allows a little more risk taking.
Yeah, I was going to point out, it sounds like higher risk, maybe higher reward. I'm not sure. Whereas private equity seems like it's focused on safe bets, or safer bets, less risky bets.
Right. And so a venture capital company, is maybe, hey, we found this, smart Berkeley graduate with this great idea, and if they can invest early and it turns into this $1 billion company, then they're going to really hit it big. Private equity is more, all right, we're going to invest 10 million and we hope to turn that into 20 million in 5 years. So maybe double it. And so Parker, where do these companies get the money to invest all these dollars? Do you have any idea about that?
That's a decent question. I don't know. I'm just, in my head, it's coming from just somebody who has a bunch of money to spend. Maybe that's somebody who has just like a massive fund that they inherited and they need to figure out how to invest their money, or I don't know. Actually, the answer to that question. Just, it's like, Bill Gates, or I don't like Richie Rich, like somebody with a bunch of money.
I think you're too young for that cartoon reference, but
there was a live action Macaulay Culkin movie in my generation, so
okay, fair enough. Yeah, well, so Parker, let's talk about that. And there's broad ranges for this, but if you wanted to have a stake in a private equity firm, in general, you need to have probably about $500,000 or more to actually be able to go in and be part of a private equity firm. And with the idea then, that they're going to try to guarantee the people who invest in them better returns than the stock market, by putting in that $500,000 or $1 million. It can be individuals who put the money in. Sometimes it could be like a pension fund or a retirement plan, or, people who groups, certain groups that have
Right.
lots of money for investment can come together and, hey, we want to invest in, a mental health group of businesses. And then that can be part of that portfolio that they have for their retirement savings or pension groups. For venture capital, as an individual investor, you need much less money. There's even some things where $1,000 could maybe get you a piece of a special project. It's probably more in the 50,000 ish and up range as an individual investor to be able to invest via a venture capital company, but which is still, again, out of reach for 99% of individuals likely in the country. But yeah, those are the costs that are needed. And
So when you say like a group of individuals, is it just kind of like a group of individuals that each themselves have a lot of money and they kind of pool their money together to get into investing?
oh, well, I think that's certainly possible. I guess when I said that, I mean more like, so I know people who are starting their new venture capital fund. And so, hey, how are they going to get money to invest in these companies? They're going to go make presentations to, the firefighters retirement fund and say, hey, give us, X million dollars from your fund, and we'll try to get you 25% returns in 10 years. So a lot of it is kind of sales to large people who represent large groups of individuals' money is one path.
And it's all with the hope of essentially increasing that number, really, increasing your dollars.
Right. So if a pension fund, they do 70% of their investments in very safe bonds, or maybe 20% in stocks, and then 10% though they go risky and like, let's put that into a venture capital fund because maybe it will hit it big, or and this is, I'm sort of making up those numbers, but I think might be realistic. But that's how they go present to some of these, state run and union, and those big entities have lots and lots of dollars to sort of hand out. Yeah.
Okay. Well, yeah, this is all very interesting just because, these are words I hear all the time and I have like a very basic understanding of them. But yeah, this is helpful for me. I'm hoping it's helpful for the listener. So with that kind of basic primer in mind, now, how does this apply to the mental health industry? How might this apply to a mental health practice?
Yeah. So what happens then, say you're even a small practice and you have 3 psychiatrists, that practice, if people are working full time, could definitely bring in well over $1 million a year, right? If you're just seeing patients and working full time, right? Psychiatrists' average salary is $300K, give or take. And so have a few psychiatrists working, you've just crossed that $1 million threshold. If you've done a good job managing expenses, you probably have profit also. So then all of a sudden you start getting on private equity's radar, because there's so much wealth and money out there to spend, especially in more recent years, that, if you're a new business graduate and you go take a job with a private equity or venture capital firm, one of your first jobs tends to be go scour the world and find companies that we want to buy. And so, they'll start reaching out, figure out who the owner is, contact people. Hey, any interest in selling your company? And that's how they start targeting any business. And specifically because mental health has been one of the top getting investments in recent years, there's a lot of specific targeting going on for mental health companies.
Okay. So I actually had a thought as you were talking. I was like, well, hey, psychiatrists probably make a bunch of money. What's stopping them from starting their own venture capital or private equity fund? But that might be a different topic.
Yeah, and I think it's a general topic. We've talked about that there is quite a lack of business and money training for a lot of mental health clinicians and physicians and other medical professionals along the way. So that's probably more of the main reasons. But I have interacted with different, there are a lot of clinicians or doctors who get burned out from medicine who do sort of go that path to these financial services. But
Interesting. Okay, so let's say, yeah, you're running a practice, a private equity firm reaches out to you and says, hey, we would like to invest in your practice. What if I was in that position? What might be some kind of pros and cons to think about, possible advantages, possible pitfalls that I should be watching out for?
yeah, and you know the question that goes, whenever someone reaches out to you, and it is a little bit of a sales job. So if they've sort of, if they identify your company and then you see private equity and then money gets people's attention, that can sort of start you down this path. And I think the big question before you even begin down this path is, why did you start your business or your practice or your company? Was it to, try to make a lot of money and save up for your retirement and be done working as soon as possible? Then, hey, maybe private equity or selling your business is totally fine and appropriate. But did you start your practice because, you love your profession and this is going to be your job for years to come? Or, sometimes the lure of dollar signs helps you think, oh, this is going to help open more clinics or hire more staff. And all that may be true. But if you're coming into that thinking this is going to help provide more services for people, I think the cautionary tale, and I know that this is maybe coming up a little bit later, is the only thing that, from a very basic level for private equity or venture capital, they're just trying to make money. They're just trying to earn money.
Right.
Yeah. However they can do it. And it's not necessarily mutually exclusive that you could grow and serve more people and do good care. Unfortunately, their bottom line isn't do the right thing and help as many people as possible equal with make money. It's just make money because they've got to report back to their investors.
Right. So, I mean, somebody could have, actually, I think you said it perfectly. It could be a symptom of that extra investment that you do kind of fulfill your moral mission to see more patients or expand the quality services that you provide, but it is important to keep in mind that at the end of the day, the investment that goes in has gone in because it's intended to go up, or so that they can get a return on that investment. So that's well said. So would there be really any concern about how you operate as a clinic, the type of patient care that you provide, or your autonomy as a clinician to provide the right type of services that you deem to be the most helpful to your community?
Yeah, and this is sort of well documented, and maybe in the links, Parker, we can include some reports on sort of the general effect that private equity can have on how clinics or groups run and operate. And yeah, I mean, it is, especially in mental health, there's kind of a right way to do things. And we know psychotherapy is the best treatment for almost every mental health diagnosis. And so, trying to maybe limit doctors to not being able to do psychotherapy and just do medications, it sometimes it can lead to, well, we're doing something okay for more patients, but we're not still doing the gold standard. Like, how important is it to be in a setting where you get to practice without this pressure or threats of shifting how you work in order to meet sort of the financial pressures? I think the other piece for mental health practices is that it's sort of unique businesses because it's white collar service providers. So the real value from these businesses is the core of excellent clinicians that work in them. And so I know some specific stories where, say, it's a little bit out of the field, but similar. Like, there's a husband and wife veterinarian team, say, somewhere, and they've been really successful at growing a vet clinic. And then I do know a story where, people had a couple million, the business was making a couple $1,000,000 a year. They sold a majority stake to private equity. Part of that deal was you need to keep, the clinicians need to stay there and keep working. And then one of the owners, got sick and had to go on disability. And then all of a sudden the revenue stream wasn't what it had been because it relied on service providers, much like mental health does. And then all of a sudden there was lawsuits and problems and turned into a nightmare for the people involved. And that is the caution.
Well, so I'm kind of thinking about one of our early episodes. We talked about this concept of, like, as a mental health provider, your goal is to help your patient, and in an ideal world, you wouldn't have to always be seeing your patient. And this isn't true for everybody seeking therapy, but you'll see this a lot where, like, therapists have the mindset that, like, the purpose of going to therapy is to help you not have to go to therapy anymore. So, I guess does that kind of affect, the mindset, or just like the, thinking about, I guess I'm kind of thinking, like, does like the needing to provide some kind of financial return have, like, a really significant impact on, clinical decision making? Or, well, I guess I'm almost kind of answering my own question as I ask it. Like, ideally, no, right? Like, you wouldn't want anything to be affecting your clinical decision making, but I can imagine that there is this potential negative when there's money that's being now considered in the business, then it needing to kind of be growth at all costs, that certain things like, hey, we don't always see our patients forever, and we need to get new patients, now kind of become kind of a cause of concern, or, like, how do we turn that into a more efficient pipeline, or, I'm kind of thinking out loud right now, but, any thoughts there?
Yeah, I mean, I think anytime, right, there's always the pressures and lots of things to balance as a mental health clinician. And whether you're a cash practice or solo or work in a group or take insurance, there's always some trade-offs or pressures. And I think, some trade-offs in care are maybe reasonable. Like, for example, accepting Medicaid rates as a physician. And most Medicaid contracts won't allow you to do therapy. So if you're a psychiatrist that likes to do a lot of therapy, but you're not going to be allowed to for Medicaid patients, but you know that you can do a good job with the prescribing and hopefully help the person get connected with a good therapist. So that's not your ideal setting, but sort of you come to terms with it. I think the danger from, when there's sort of this more direct pressure that, you've brought on these outside people who are putting money in, and there's these requirements around revenue generation, whether you're shouldering that as the business owner, or whether, people become aware of it, it does, subconsciously or not, have an effect on how people work and practice, and that is real. Yeah.
So, yeah, I guess it kind of goes back to what you were saying earlier, like you keeping a focus on your core values, or why you decided to start a practice in the first place. And yeah, I just imagine like there does become a little bit of pressure towards the financial side of things. That's a little bit outside of your control.
Yeah, and
So,
it's
go
the
ahead.
giving up the control is probably one of the biggest things people need to think about whenever you're talking to someone about outside money. And
Mm,
it's not fun to take out loans or other, second mortgage or other things to keep your business going yourself. There's risk to that, but it is a way where you get to keep full control of the company and the direction. And I think the other piece is often private equity, especially, and sometimes venture capital, they'll sort of say, hey, we're business experts. We can really come in and help you. We know how to do, you know, we have this business training that for people who are clinicians, it's mysterious. And sometimes you think, oh, they're going to come in with these secret business tricks to really make things better. And I don't think that reality is true. It is sort of a sales pitch, and that you probably know the most about providing the great care, and there's not necessarily some sort of magic. um, People haven't learned something magical in their business school or MBA training. And I think clinicians should need to be aware of that. And so when people try to say, we're going to bring you all this help with X, Y, and Z, being very specific about what exactly are you going to do to help the business serve more patients.
yeah, and I imagine that comes with a lot of its own changes, and needing to, I guess, like set expectations for both yourself and for any employees that are working with you, on yeah, what kinds of changes can be expected now that outside money is coming in, because the previous way of doing things may no longer be considered the operationally optimal way of doing things.
Yeah, yeah. So, and right, I think sort of the summary message is, if you've started a private practice and you've grown it to a number of employees, and you're kind of getting near retirement or ready to do something else, and want to be done with the business, then, selling the company, and stepping out completely is a very reasonable and appropriate thing to do. The Having people, your staff, that you're leaving, but your other staff is staying, that's the value of the business. And so if
Right.
when you retire, everyone's, or leave the company, there's going to be exodus. The That's going to be a problem, because most companies sort of say, yeah, people cannot leave the business, and that's an extra caution for mental health clinicians. I think there's also instances with, we're talking, it's more relevant for private equity to buy a clinic, but from the venture capital perspective,
Hmm.
if you've developed some type of innovation in mental health care, like through some software, treatment outcomes, an app, I know stories where companies have come in, venture capital companies have come in and bought out those companies just to shut it down because they
Oh.
have a competing product or venture. And that can be sort of, it's this other thing where, yeah, are you looking to just sort of be done and sell your business or product and move on to something else in life? Or is this your life's work and you really want it to be out there to help people? When you sell, you don't really get to choose that. And yeah, some people very clearly thought one thing was going to happen with this innovation they made to help people with mental illness. And then on the worst case scenario, it was just shut down because really the company that bought it has their own product in the pipeline. And
So yeah, I mean that's a good like real world example. Do you have any kind of other like real world examples, both either positive or negative, where outside money changed the trajectory of a mental health practice, either for the better or for the worse?
yeah, I think there's a company called LifeStance, which was the first mental health provider that went public, but publicly traded. I think people can Google that and sort of read about it, and look at the starting share price, some of the lawsuits that have come from it. That's a good company to sort of that has had a lot of news about it because it was the first publicly traded mental health company, and
Yeah,
that
it's
I
an
think
interesting
that's what
case study.
yeah, I think that's what I'd refer people to. Yeah, and I have some real world experience here, but it's probably a very large subject and series, so we won't go into too much of that personal experience. But of course, people can feel free to contact me individually as needed if they've been approached by private equity or venture capital. And I think Parker, the other interesting thing is, right, probably once a week I get a message from someone, from one of these probably young kids at a company that have found RipsyTech on the web, and they start, though the template is almost always the same, like, love what you're doing, found your great company, wow, da, 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 can we have a conversation about how we can be great partners and help your business grow? And years ago I used to sort of take a couple meetings, and then now I maybe once every 3 months I might talk to someone, and but it's always the same thing, that people are just on the lookout for companies that are doing well. And in my mind, it's always, well, if we're doing well, at least at this point, I've learned, I don't see what these outside companies can actually do other than take away some of your business. A lot of them have sort of advertised, we can help you with X, Y, and Z. But in reality, I haven't seen that stuff come to great fruition. But I do have the list and save all the people who do reach out. Just
Yeah, it's a little similar to the emails I get about the podcast of, somebody with great marketing expertise who's like, oh, I can do X, Y, Z to gain you traction and this many subscribers in this amount of time. And, well, I don't consider myself perfect with the production and marketing of this podcast. I try to improve as much as we can at all times. But yeah, it's certainly like, you do lose a little bit of control, or you do lose, it's hard to know who to trust when everybody's kind of emailing you the same thing.
very accurate. Very accurate.
Yeah. Okay, well, before we started recording, you said that you had a pretty good mental health business moment. So let's pivot over to that. What I don't know if it ties to private equity and venture capital, but what's this week's business moment?
It is about money.
Okay, money. All right.
It is that even after let's see. So we're coming up on 18, almost 19 years. I've been kind of working with insurance companies and doing these negotiations. And so whenever something new happens, it's always, you feel like you've seen everything. And then, but this latest piece is, as you know, Parker, we're looking to expand services in Hawaii, the nonprofit agency. And so we managed to reach out and connect and with one of the insurers that we work with in California. And they said, yeah, we'd love to have you. And here's all the contracts. And normally the way it works is at the end of the contracts, there's amendments that say how much you get paid. And so I didn't see that. And so I emailed them back like, hey, I didn't see the rates anywhere. Here's the, how the rates we get from our, your entity in California. Did I miss where it's located in these contracts and documents? And they essentially wrote back and said, we don't put what we pay people in the contracts because we can change it with 60 days notice at any time, and we don't want to have to keep regenerating contracts all the time. And, the reality is all these other contracts we have that have the rates have that 60-day clause regardless. But it was sort of this moment of like, do people really sign contracts where they have no idea what they're going to be paid for the work they're doing? And like from a basic business and accounting level, you need to know what you're going to get paid to make your budget and track earnings and all of these other items. And so it just felt, it was such a it's just a bizarre statement to say, we don't put that in the contract. They did offer to, they said, give us the CPT codes you bill and we'll send you the current rates for those. But they could just be lying about that. Of course, it's not in the contract or in writing. But anyway, that was the bizarre business moment of the week. I've never uncovered in all these years of doing this. And so new surprises. Who would sign that not knowing?
Right.
It's sort of like you don't buy something without knowing the price, and it's just very bizarre.
That is interesting. Yeah. Yeah. I hardly know how to react to that just because, it's so, it's another one of those things where, the lack of transparency when it comes to, not all things related to working with insurance companies, but it seems to be the unknown seems to be kind of like very advantageous for the insurance industry. I guess that's what I'll say.
Yeah.
All right. Well, anything else you'd like to say before we wrap things up?
No, I hope we're trying a little new higher quality video recording setup, so I hope that goes smoothly. But
I will say it looks like there's some light below you that is like now you've gone into full blown spooky story mode.
Yeah, the it's the sun. I hope it's not. I should have had the blinds closed, and so now there's the screeching noise, and the timing of the day shifted because we were behind schedule. But
yeah, no worries. All right. Well, this has been fun. We'll see. We'll see how it looks in the edit. All right. Well, thank you for tuning into this week's episode of the Sit and Stay podcast brought to you by RipsyTech. If you have any questions or you're interested in featuring as a guest on the show, please send us an email at sitandstay@ripsytech.com. All right, Tom, I will see you next time.
Thanks, Parker.
Bye.
Thank you for tuning in to this week's episode of the Sit and Stay podcast. Until we meet again, we invite you to sit and stay with the ideas and stories shared today. Dive deeper into how RipsyTech can support your practice by visiting us at RipsyTech.com.